Welcome. It has been another interesting week in the world of the property market. Simon, what was the release of data that occurred last week?
Yeah, so we had a couple of things happen over the last 7 days. Last week, we had the latest jobs figures come out, which tell an interesting story, and that put a cat amongst the opinions in terms of bets or otherwise around the next rate rise.
Now, I don't know whether you meant to say cat amongst the pigeons, but you said cat amongst the opinions. And I thought that was a great play on word. Was that deliberate?
No, I think you misheard me.
Well, all right, let's go back to the cat among the opinion.
Yes, a few opinions changed about the direction of interest rates and at least a bit of discussion around what might happen next because of the job figures last week. And then this week, we've had the latest monthly inflation figures, which again weren't quite in line with people's expectations. So we thought it might be valuable today to unpack some of that, look at what the data actually says, and then think about, as property investors, what are some of the key leading indicators we should be paying attention to so we can cut through all of that media noise and panic and clickbait and make better informed decisions and form better opinions about where we think interest rates are actually going to move moving forwards. And in particular, what's coming up
Perfect.
for us just next month in June when the Reserve Bank meets next.
So let's start with jobs. What's occurred? What was the feedback in jobs, Simon?
Yeah, so last week the Australian Bureau of Statistics released their monthly unemployment figures, which is something that I think property investors should be keenly aware of if you're trying to anticipate what is going to happen with interest rates. Because the Reserve Bank has this dual mandate, right? It's not just about keeping inflation within its target 2 to 3% band. They also have a mandate to try and achieve a level of what's called full employment, effectively low unemployment. So, what happened last week was a bit of a surprise jump in the unemployment statistics. They went up from 4.3% in the previous month's stats to 4.5% in the latest stats. And that is actually the highest level of unemployment that we've seen in this country since 2021. So quite a lift. And again, put that cat amongst the opinions of a lot of economists because it was a bigger jump than was expected. Now, what does that translate to? Well, that translates to nearly 20,000 jobs actually lost during April. So that could be something that causes the Reserve Bank some pause, some thinking, because the Reserve Bank forecasts, Brendan, that they released when they put up rates at the beginning of May, those forecasts have certain assumptions around what's going to happen with unemployment. And they made plenty of comments about expecting the jobs market to remain robust, to hold up, not to really go up much this year at all. And it might be worth actually talking a little bit about some of those numbers. And as in property
Well,
investors, we're all about the numbers.
they had a very conservative growth in unemployment or nominal decline in employment over quite a period of time. And it's not playing out that way. Simon, what were the numbers that they put forward as a suggestion to forecast unemployment rates?
Yeah, because the decisions around what they do with interest rates and what they're expecting to do with interest rates in the future are all predicated on these forecasts. So when they released their statement this month, when they made their rates decision, it was interesting to see that the forecast unemployment rate was set to rise only nominally this year. So they actually had 4.2% unemployment as of June, the June quarter, and then get rising just to 4.3% by the end of the December quarter, and then gradually moving up a little bit faster in 2027 into 2028, moving from 4.4% by mid 27 to 4.7% by mid 28. So stable this year, then rising over the next 12, 18 months beyond that.
Hang on. That's not how it's played out. How the numbers actually played, because
Yeah,
4.2 seems really nice. I don't think it's been that.
well, which is ironic as well, because it wasn't even 4.2 at the time they made the decision. The previous
Yeah.
month's unemployment stats, seasonally adjusted, and what they call this trend measure, which we'll get to in a second, that was already at 4.3. So to have a set of forecasts that said, well, unemployment's actually lower than what it was at the time they published those forecasts is, in my mind, a little bit suspect to begin with. But if we've got a forecast that we wouldn't really go beyond 4.3% until after December this year, but April stats have put unemployment already at 4.5%, then that's potentially going to be a concern that unemployment is getting away faster than the RBA is forecasting.
By default, that leaves us somewhere near August 27. We're more than a year ahead on their forecast. They're about what 15, maybe 18 months ahead on their forecast of unemployment change. That's got to be freaking them out a bit and freaking out the broader market as well.
Well, yeah, although, you got to say that 1 month's data doesn't make a trend, and these figures can jump up a little bit and up and down a little bit month on month. And I fully expect that could be the attitude the Reserve Bank takes towards this if it's just isolated to April. So they have this other measure that the Australian Bureau of Statistics puts out that's called the trend measure of unemployment. So the seasonally adjusted one that takes into account seasonal factors is sitting at 4.5% as of April. But the trend measure, which is an attempt, I guess, to smooth out these bumps up and down over time, that trend measure was 4.3% in March and still at 4.3% in April. So the Reserve Bank could kind of try to cheat this and say, well, no, it's still sitting around 4.3%, so it hasn't really got any worse based on the trend measure. But the problem in my mind with that, Brendan, is that the trend measure is a lagging indicator. It lags behind what's actually happening with unemployment. And it has some weird stuff that goes into its calculation. For instance, there were 20,000 jobs or just under 20,000 jobs lost in April. But the trend measure says, oh no, there were 20,000 jobs gained. So you can't have it both ways. Either there are 20,000 people, more people employed, or 20,000 less.
Yeah, 40,000 job discrepancy is not something you can necessarily sneeze at. So, if 20,000 represents 0.2 of the population of employees, yeah, you're starting to get up there in discrepancy. So where do you think this is going to leave us then by way of I guess, perspectives around interest rate movements?
Yeah, so one of the things we've got to bear in mind is that these figures do come out monthly for unemployment. So what we've really got to pay attention to is what happens next month. Does that reinforce this? Because if it does, if it's similarly high, that will actually drag up even the trend measure above the RBA's forecasts. And so that might start to tilt things more in favour of at least keeping rates on hold for the foreseeable future. Now, how did the money markets react to that? Well, when those stats came out last week, they pared back their bets of another rate rise. And the money markets themselves started to consider that it was unlikely we'd see a rate rise in the next month or so, at least. They do change their minds every week based on the data that comes out, but that's sort of one key indicator. The other thing, so the Reserve Bank has those two mandates. Let's try and achieve some level of full employment, keep unemployment relatively low, but as most people are aware, we've got to try and contain inflation and keep that low. And the latest monthly inflation stats came out this week and provided a bit of a mixed picture around that. So the headlines were screaming that the inflation rate, the headline inflation rate, had dropped sharply from 4.6% year on year in the previous month's statistics to only 4.2% year on year. So it's a fairly significant decline in headline inflation, despite what's been going on with the Middle East and the fuel crisis and everything else. And part of the reason for that decline was actually that fuel prices in the latest data had actually come back down from where they were the month before.
And that was on the back of, again, if you listen to the media and you listen to the politicians, aren't we good? We cut excise in fuel, and therefore by default we influenced the fuel prices and therefore brought inflation down. Gee, we're good. Now, if you take that into consideration as a grain of salt, okay, great move, but then it becomes a policy-driven shift as opposed to a natural order of inflation-driven influence.
And you've got to bear in mind that this is also a temporary measure. So cutting the excise on fuel which dropped fuel prices, 25 cents or so per litre. They're already saying that, they being the government, are already saying that they don't plan to extend that cut beyond the end of June. With leaving the door open slightly a crack in terms of they're still
Should
obviously
be
always
some
reviewing
other
it.
shock. Yeah.
Yeah. So what do you think happens to the headline inflation rate when that excise gets reinstalled, when that tax goes back onto fuel?
Obviously,
Some
fuel goes back up in price. People have to pay more, and then there's the impact again on CPI as a result.
Exactly. So headline inflation will jump in that month as well, in the July data when that eventually comes out in August. So the Reserve Bank would be looking through all of that right now, and not really paying any attention to the headline figure. What they focus on more is this thing called the trimmed mean, which they try to strip out these volatile items like what's happening with fuel prices and look at what's really happening in core inflation, the other goods and services that people buy. And that trimmed mean was slightly up year on year in the latest month's figures. So the previous month's figures had shown year on year 3.3% trimmed mean or underlying inflation figure. That crept up to 3.4 in the current month. And that caused some in the media to go, underlying inflation's going up. That means, rate rises are back on the table. I've seen some commentators saying the Reserve Bank should just get it over with and lift rates multiple times in rapid succession as well. So you get these extreme views. But when you look a little closer, so I had a bit of a dig down into some of the data. I wanted to look at, well, month to month, what's actually been happening in the trimmed mean inflation. Because whenever they put out these annual figures, Brendan, you got to realize that, and I think many people don't understand this, is that what's happening is the oldest month of the data is dropping out and the newest month of data is coming in, but you've got another 11 months that are still more or less the same as they were in the previous month's release, forming part of that overall picture. So if you had a particularly low month of inflation 12 months ago, and then that drops away, then naturally inflation is going to go up when you measure it year on year, because the oldest month that was particularly low has fallen out of the data. Even if it hasn't actually sped up or gotten worse in the most recent months, if it's been fairly steady, it still looks worse year on year because that oldest month was particularly good compared to the following 11 months. And so people have this knee-jerk reaction like, year on year inflation's gone up, it must mean that inflation's out of control again. But I looked at the monthly data, and really for the last several months, each month has been essentially like 0.3 or 0.2 for the month. It hasn't really sped up. It's been bouncing up and down between 0.2, 0.3, and the most recent one was just 0.3 again. So you could argue that there isn't a worsening of inflation. It's not speeding up, accelerating, or anything like that. It's kind of just more or less the same as it's been for the last few months. And I hope the Reserve Bank's smart enough to actually see that and take that view rather than focusing on this year-to-year figure and making a
And
knee-jerk reaction to that.
you and I have talked about that a lot, and you do measures very regularly on the idea of what's quarterly changed, quarterly
Mm,
times four, annualize that, you'll get an idea of where the market's actually going as a leading indicator for the year-on-year outcomes. And that month-on-month exaggerates that further. It's just simple mathematics. But the concept there is if you had a reliable point 0.2 to point 0.3 month on month, then we've got a relatively stable environment. I mean, you're not getting, admittedly, month on month, a small variation in a month on month can have a significant impact accumulated over 12 months. No argument. But it's not 0.15, 0.15, 0.15, 0.2, 0.2, 0.2, 0.25, where you've got an acceleration that it's obvious. What you're
mm.
seeing is a basically minor modifications month in, month out of a fairly stable environment, which is really great from I don't know that we need to necessarily put interest rates up to cool it down, or not so great if you're looking for a decline because it's not necessarily speaking to that either.
And I think that's the key issue here that makes it difficult for the Reserve Bank moving forwards, is that trimmed mean, that underlying inflation, still sitting above their target band. So it'd be best described as sticky. It's not necessarily running away. Obviously, there's the risk of prolonged issues with Middle East and the Strait of Hormuz and fuel prices flowing more and more into the underlying inflation rate over time and pushing that up further. So there is still the risk that that could go up, but it's not coming down as part of the issue. So if the drive is to get that back inside the 2 to 3% band, it's not really shifting down yet for obvious reasons, and many of those reasons really outside the control of the Reserve Bank. So you find yourself, if you're a Reserve Bank board member, you find yourself, I think, in a very awkward position now. You've got trim mean inflation still above the band, not unexpectedly, but more or less where you thought it was going to be. But now you've got worse unemployment figures potentially starting to emerge that are worse than your forecasts. And you have a mandate to try and keep unemployment down whilst trying to contain inflation. So you're stuck between a rock and a hard place. What do you do?
See, it's interesting, Simon. I've heard you be sympathetic towards Reserve Bank board members month in, month out for a long time. I do
Well,
appreciate
I'm
your
not
sensitivity to the
particularly
dilemmas that
sympathetic.
they
I
face.
think scathing
That
might be
said,
something might be more
that said,
accurate.
they are making the decisions and we are stuck with them. Simon, what do people need to watch now as indicators of what's
Yeah.
coming up to avoid getting buried and emotionally engaged in media headlines?
We've seen a couple of the key indicators. So the monthly employment stats and monthly inflation stats are obviously a couple of key ones to keep an eye on. And there will be some new ones coming up next month. 25th of June, I think the unemployment figures come out. So you'd want to watch out for that. 26th of June is the next monthly inflation figures. But before that, we've got a key health check on the economy that's coming out. So in the first week of June, 3rd of June, we get the economic growth figures that come out every quarter that tell us how healthy the economy is, the GDP figures. And what we want to do is pay close attention to those, because if they are materially worse than some of the forecasts, and you'll see that in the headlines if they are, then again, that gives the Reserve Bank reason to pause and go, well, if we increase interest rates, we're potentially going to drive growth even further below our forecasts. And that's starting to get even more damaging for the economy, more damaging for unemployment, and makes it even more difficult to maintain that balance in their dual mandate. So I'd watch out for that, because that's then going to be followed by the RBA rates decision on the 16th of June. I'm not necessarily expecting a change there in terms of rates, but what they say will be important in terms of understanding what they're looking at moving forwards. Then after that, the next Reserve Bank meeting won't be till August, so they kind of take a break in July. But in between that, you'll actually get the important quarterly inflation figures come out. And that does tend to be one of the key metrics that the Reserve Bank focuses on. They're less inclined to focus on the month-to-month inflation stats, but they do focus quite keenly on the quarterly ones. So as investors, those are the sort of key bits of data we want to be paying close attention to over the coming weeks and months if we want to understand what the Reserve Bank is most likely to do.
You said, Simon, in your commentary just then, you're not anticipating a rate change in June. Must
Mm.
declare, I'm not either. I think there'll be a real suck it and see position from the RBA. I dare say they're going to lean back in their chairs and go, don't know that we need to make any move. Let's have a good coffee. And there'll be quite an intense discussion around what's actually going on. But with respect to the debate around change or not change, I think that the vast majority of people in that board meeting would be going, yeah, let's not. So it'll be interesting to see if unanimous.
Yeah.
Is there anyone in there that's going to go, no, we must rise, or no, we must
Yeah.
decline, and drop them? And it'll be interesting. But I think the vast majority, given that we're going to get that report, will be, don't do anything.
Yeah, and not everyone shares our opinion on that as well. So there are certainly
Oh, sure.
commentators, economists out there who are still betting on a rate rise in June. In terms of the big banks, like the four big banks, one of the big banks was anticipating an upward movement in rates in June, really until just a couple of days ago when they've revised that. They've pushed that out to August now. But the big banks don't agree here either. Like two of the big banks, they believe that rates have hit the top of the cycle, that they're not going anywhere, or certainly not going up for the rest of the year. or for the foreseeable future. And the other two banks, I think maybe you get one or two rate rises before the end of the year. So even they can't agree. The money markets are betting on no rate rise in June, less than a 5% chance of a rate rise in June. And they've really kind of pulled back their expectations of future rate rises as well. They're currently just pricing in maybe, not a certainty, but maybe one rate rise towards the back end of this year before rates have peaked, and then they start to come back down again. So we'll see. I mean, it wasn't that long ago that the money markets were betting on two more rate rises inside this year. We'll see what actually happens. But yeah, if I was a betting man, I'm not a betting man, but if I was, I'd be saying odds are that there won't be a rate rise in June, and the Reserve Bank will be very much taking a wait and see approach for the time being.
Yeah. Seconded. Guys, I want to thank you ever so much for joining us today. For those who are new to us, welcome aboard. Can I encourage you, if you haven't already, fill out your profile details so that people can see you, you can see others, and you can start to build and support the community and find information or answers to questions that you might have by leaning on others who are already in that space and doing well for themselves. So that would be an invitation. We are back next Thursday, same bat time, same bat station. And until we meet again, invest wisely. Thanks, guys.
Thanks, guys. See you next week.